properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro, Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
The stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money's coming to me. Money sets me free. I'm a money magnet. Money's coming to me.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network. With your host, Phil Grande.
I feel pretty good about things. I think that the economy is going to prove resilient. I feel pretty...
Prove resilient. We talked about that the other day. And it's amazing. Welcome. You know, these jibber jabbers can really get you in trouble. And one thing you got to look at to keep you out of trouble and to identify which way the market's going to go. You don't get it from them. You get it from the bond market. The bond market will tell you, okay, what is the market going to do? All right? And there's a great example of that. The other day, this was on, when did I do this? This was back in February, I think. Yeah, February. Here's what I said in February on one of my podcasts. I'll play it for you here. We were talking, here we go. Let's take a look at IWM. Look at this. It's breaking down. That's right, IWM. And why is IWM so important? Watch IWM. That's the Russell 2000. The reason why that's so important, because every professional, all the institutions that drive the market, this is what they look at, because it has a wonderful ability, a powerful forecaster. It tells you what's going to come in the future. It's never wrong. And it's closely, the reason, because it's closely aligned to the financial health of our economy, because it's closely aligned to the labor market, which the labor market is everything, okay? So, but IWM is warning. It's telling you something's coming. Now, this was, again, around February 5. You can see it on my chart. That's what the market looked like. That's what IWM looked like. And I said, it's warning you something's coming now. Keep your eyes on the chart. And it sure did come, didn't it? Bam, look at that. That's when we had the 30% drop in the Russell 2000. That's what you have to watch. It leads the market. Because, remember, it reflects what is truly going on in the economy. And you saw it right there, how it just dropped. And that led the S&P down, that led the NASDAQ down. That's the guy that's going to tell you which way the market is going to go, okay? And another thing that's interesting, if you go look at this guy here says, this is another interesting, he said, where is it, right here, yeah. Listen to this guy here, he was on one of the financial shows.
So you see again today, and this is alarming, the combination of falling equity prices, falling bond prices, and therefore higher yields, and a weaker dollar. Because normally, when yields rise, the dollar rises because people get paid more to hold it. So you have to conclude that investors are now desiring a higher risk premium to own U.S. assets, and you have to think there's some capital outflow going on with a greater preference at the margin for foreign assets and gold as compared to U.S. assets, because you see an all-time high in gold, and you see a 3-year low in dollar euro, for example.
So here's what he's talking about. If you go back and take a look at, let's say, look at TLT, and that's the bond market. Now, if we go back to April 1st, right here. You can see it on my chart, April 1st, right there. That's when Trump made the decision about we're going to do tariffs. No big deal. Okay, and so you saw that the bond market is doing what it's been designed to do. It felt that, okay, you're going to have some inflation here. So what's happening is the bond market, okay, was going up, and your interest rates were coming down. Now, why is that? Well, it's designed so that it will help cushion the 401 people who are losing money, and every time, and also the buy and sell people, the diversified people, the 60-40 people, right? So when the bond market was going up, and all of a sudden the rates were coming down, that is how it's designed to work, so that the 401ks would lose less money, right? So, and that's the idea behind the bond market. So what he's saying is that things all of a sudden reverse. So as the bond market's going up, interest rates are going down, everybody's happy, 401ks are getting cushioned, the buy and hold, they think they're protected because they're 60-40 diversified. And the next day, what happened? Next 2 days, things got worse, right? Talked about this yesterday. So all of a sudden now they're going, whoa, the tariffs, right? So now they're thinking we're going to get a lot of inflation. And so what did the bond market do? Did the opposite of what it's supposed to do. So the bond market's smart. So the bond market sent a message. So all of a sudden the bond market, instead of going up, it turned and started to come down. And then interest rates, instead of going down, turned and started to go back up. Why? Because it knew it had to fight inflation. So they were not protecting the 401ks anymore. They weren't protecting the buy and hold, the 60-40. So that's when we saw the severe move in the bond market coming down, and we saw yields going up, and everybody was getting hurt, right? So the bond market's pretty smart, and that's what you listen to. You follow the bond market, and you'll know what interest rates are going. And here's the funny thing, too, what was happening. All these people were buying stock, okay? And the stocks were going up, like right here. All the stocks were going up. And they're buying stocks that were in a downtrend. See, they think when you see the candlesticks going up, hey, we're okay. The downtrend's over. The trend's on its way up now. No, it's not. You still had over here. You got to make sure you don't get misled, okay? What we have here, remember, is a downtrend. That's a downtrend. So you're going to have, as the trend's going down right here, right, you're going to have interest rates going up. So people were buying, thinking the trend going down, okay, was over. So I'm going to buy stocks. And that the interest rates going up was over. No, because the bond market's going down, the trend's going down, interest rates are going up. So all these people that are buying are going to get hurt. Now, why do you have to listen to this? Because if you listen to the jibber jabbers, for example, when you hear them tell you about how great the economy is stable, right? Like this. Let me just get it for you. All right, I think I have it here now.
The stock market is driven by big companies.
No, let's see, I got the wrong one. I think it's this one.
I feel pretty good about things. I think that the economy is going to prove resilient.
How can you be resilient when, again, the Russell was telling us something was wrong, and it was correct. So if you listened to the Russell, you never got caught in that downtrend. You would have been shorting it, number one, and you've been making money. But if you think about the Russell 2000, it's 80% of our GDP growth, which means it's 80% of our jobs created. That's pretty important to the bond market. And then we're telling how, okay, things are stable. Well, they're not very stable because the labor market, okay, is really slowing. And the increase in job cuts since January up 243%. That's the highest since February of 2009. And that's why the FHA, nobody's talking, you seeing how resilient we are? Then why is it that we have 10.7 million FHA households or loans that are currently, okay, behind in their mortgages, in default? Now remember, when the FHA got in trouble in 2009, and in that 2009 area, 2010, they've given, the amount of loans have gone up 1,000%. Think about that, 1,000%. Now we're sitting here, and as I said, what's hurting those FHA loans, because they only put down 1%, they're losing their jobs. And we never seen a job freeze like this, or the amount of jobs that are being cut. So when you listen to them, they're telling you things are good. And I got more cuts like that, how the economy's great, the economy's good. But see, isn't it interesting how the bond market knew about the FHA? The bond market knew about the FHA, and we're not in good shape. And they also knew, the bond market knew when it turned and TLT went down and they had to move rates up, that the debt to GDP ratio, okay, 124%, it should be 30. And from October 1st, 2024 through January 31, 2024, in just 4 months, Congress keeps spending $2.4 trillion, but only collect $1.6 trillion in taxes. They're in a hole of $840 billion, and a deficit, and they don't care. But see, the bond market knows that. So when I said to you, the bond market said, something's wrong here, something's going to happen, this is what the bond market's reacting to, and especially the labor market. And these people keep going to tell us how great the economy is. Now, we're in an industrial recession. There's no doubt about that. But yet, people don't understand. Companies are setting a record hiring freeze, and corporate bankruptcies are at record highs. 282 regional banks are failing due to commercial loans. And bankruptcies increased 14% between 2023 and 2024. But January 2025, where we're now, year to date, they've increased 26 or 25% over 2024. Let me repeat that. Bankruptcies increased in 4 months, 25%. The highest first quarter bankruptcies ever. And the other thing they don't understand is, they say how great the consumer is, how great the consumer is. No, remember from 2009, the consumer was set up to get screwed. When they did QE, they screwed the consumer, because the top 10% were spending all the money. The top 10%, they're the ones that are responsible for over about 60% of the retail spending. When you get those numbers, retail spending is terrific. You wonder, how the hell can it be terrific? Gas is up, food's up. Because they do QE to flood the banks with money, and it pushes down interest rates, so borrowing is more attractive to that top 10%. The very wealthy. That's what QE is for. They're going after the top 10%, so they will spend. So you got the top 10% doing all the buying. And you want to know why mortgage Mortgage application declined up to 42%. That number just came in. Mortgage application declined up 42%. But think about that. All the noise we got about QE, how it's going to take care of and then what happened with QE? It drove the stock market up, right? It drove this between QE and the 24 trillion in stimulus money, another 14 trillion in stimulus money, drove the market up 1,200%. On the NASDAQ size, about 600 to 700% on the S&P, had nothing to do with earnings. Nothing to do with earnings. It had all to do with flooding, okay, all this money, stimulus money. And then, so you got QE making sure the very, very rich are going to be taken care of with QE. Flood the banks with money, give it to the top 10%, and give it to the companies that are in trouble so they can buy their own stock, so they can push their stock up without having profits or without having sales. That's what, amazing, that's what the bond market picks up. But nobody gets it. Nobody gets it. And once you get that, you'll always be on the right side of the market.
Want more information
Be right
on
back.
this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
Hi, I'm Phil Grande of philsgang.com. You know, over the years, I've successfully taught tens of thousands of investors how to navigate the market with confidence. Become a Phil's Gang member and receive the training, the advice, and the software that will take your investing to the next level. You know, I have a team comprised of successful investors, all with proven track records. And the Phil's Gang software is easy to use, painless to navigate, and tells you exactly when to buy, when to sell, when to hold, when to run like hell, even short. Learn about common market mistakes and how to minimize them. You don't have to be a seasoned investor to benefit from Phil's Gang and platform. No matter what level investor you are, my strategies for investing are designed to put you on the path to success. Sign up for the 10-day free trial to see our platform in action. Avoid market pitfalls and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com.
Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
Recession would be a self-inflicted one, because today what you've seen in terms of earnings reports is that companies have done quite well in the first quarter, but they're all worried about the uncertainty that's coming with the tariff regime put in place.
Companies have done quite well. Really? The companies have done quite well? Well, that's another thing. Think about it. You take all the markets, 30% of the value goes to 7 stocks, the Magnificent Seven. And the Magnificent Seven's in deep trouble because, again, the big institutions, the big hedge funds, they've already announced they are not going to be buying the amount of NASDAQ stocks that they used to buy. They're staying away from the tech stocks. And because, again, the more interest rates go up, and interest rates are going to continue to go up. And that's really bad for tech stocks. And here's what's interesting. when you go look at the tech stocks, see if I can find them here quickly for you. You go look at the tech stocks. Okay, you're there. All right. And people are jumping in buying these tech stocks. So let's take a look, for example, they're buying Amazon. See it right here, Amazon? Look at the trend here. The trend's been going down forever, right? And that's where we short it. When our chart turned from green to red, that tells us that money's coming out, and it's going, that money was in, but now money's going to be coming out, and it turned red. So you short it right from here down to here, okay, the 80% to our 30%. That's what we teach our students. Underneath that, this is a whole downtrend. When you get under 30%, that's sub-trend. That means you're in real deep trouble, okay? And few people know this, and they're in there buying in the last few days. See how you got the Amazon going up? But it's not going to go anywhere. It's going to turn around and come right back down. People don't realize that because you're in a downtrend. But people don't know what a downtrend is. They don't know what an uptrend is. They don't know how the bond market works. And they don't understand right now that the bond market is telling you something. Okay, we got the bond market still in a downtrend, okay? And right now, interest rates are still going to be climbing, okay? Still going to be climbing. The bond market, even though it's going up for a couple of days, okay, doesn't mean anything. See, that's what they don't get. So they go in and they jump in and they buy the tech stocks, seeing if they see the bond market going up, right? And everybody on TV is telling you, look at this, interest rates now are going to start coming, interest rates are going to start coming down now, right? Because the bond market's going up, so interest rates are going to start coming down. Well, that's maybe for a day or two, but that's not what the trend is saying here. The trend is saying, no, that's not true. This is called a snapback. That's all it is, snapback. Now, if you want to catch a snapback, you switch to your Pro 1 chart, which is a short period of time, it's condensed, and you do what you call a swing trade. You take advantage of that and you catch that on a swing trade. All right, if you're like a day trader, okay, you can do a swing trade and take advantage of that. But see, how do you know to do that? Because see the trend here? The trend is going down, right? So the trend's going down. It's telling you money is coming out. This is a snap back. It's mostly everybody who's shorting is buying their position back to take profit. But people just see it going up and they think in their mind, boy, I'm gonna buy the hell out of this stock, okay? Because again, it's going up. No. So just because, again, when you watch your bond market, okay, always remember, yes, the bond market's going up now, and yields are coming down, but the trend's telling you that's not going to last. So if you want to do a swing trade for 2-3 days, let's say you go and you buy, I don't know, let's say you go buy, let's see, Amazon. Yeah, you go buy Amazon. See Amazon here? It's in a big, severe downtrend, right? The color-coded chart's telling you it's not green yet. And what do we know? We know that the overall bond market, right, that the TLT is coming down and interest rates are going up. And that's not good, especially for tech stocks. But look at the people who are buying tech stocks when, again, tech stocks want low rates. But the bond market is not going to give us low rates, okay? And so you may get them for a few days, okay? Like right here, you may get them for a couple of days because it's a snap back, but it will end and it'll come right back down. So all these people who are buying these tech stocks, look at this, these deep down trends. Look at today. Somebody's in there, I got to get into Tesla. I got to get into Tesla. Okay, then just do it the right way. Switch your chart over here and just know this is a swing trade. And see, the trend, that trade is almost all over, almost done now, see? Because you got to switch charts because the time frame is short. See how your time frame on your Pro 1 is really, really short. So you can take advantage of this. Now that's an educated trader. He knows, he's saying, okay, I'm watching TLT. I'm seeing TLT right now, okay? I'm seeing TLT where interest rates are coming back down, okay? But that's not gonna last long because, again, I'm in a downtrend here, and I also know I'm gonna just take advantage and do a swing trade on this chart. So when you have your bond market, or your TLT is referred to it, going down, and your interest rates going up, and you're buying stock in a downtrend, you can't have a worse scenario. But if you switch position, I'm not going to do a position trade, I'm going to do a swing trade. So you switch over here, and you buy it right on the bottom here. They can't see it, can they? No, they can. Oh, they can see it? Okay. And you see on my other chart here how it's on the bottom and the stochastic's going, you're going to catch a nice trade, see it? But it's going to be over. The people who are buying this think, oh, it's going to go all the way up here. They don't understand, okay, that the trend right now is down, and our interest rates are going to continue to go up because TLT, okay, overall is coming down. We just got a snap back for a couple of days. It's going to go right back down. Okay, it's going to go right back down and pull interest rates right straight back up. And this is where you get the losses. Now take a look at, let's take a look at another one here. Let's take a look at Microsoft. So everybody jumped in Microsoft, but they're doing it in the wrong chart. But see, the beautiful thing about this chart, see how it's all red? It's telling you there's no money going in. So, and it's telling you you're in a downtrend. And when you go back and you go look at your bond market, TLT over here, you can tell TLT's in a downtrend. This is simply a snapback. It's a snapback. And even worse, if you go back to your April 9th and you draw a line on the top of your April 9th, because what we're doing, we're pivoting off April 9th, right? And you take your April 9th and see where it's all been stuck inside here. Anytime you get a rally that is what we call a relief rally, okay, let me bring this back a little bit for you. Anytime you get a relief rally, bring it back like here's 1 month. Okay, so again, this was April 9th right here, all right? This is any relief rally. You take a look at the chart that day, you look at it, okay? Just, all right, you draw a line at the top, then you draw a line at the bottom, and if everything is staying inside, okay, it's telling you something's wrong. Now, we can probably figure out what it is, okay, because we know that interest rates are going the wrong way for tech stocks. So if you got your TLT, your bond market, I'll put it in white, is coming down like it has been, and you got your interest rates going up, how are you gonna get your tech stocks to rally? It's not gonna last. They want low rates. So that's why you get 80% to 90% of people losing money, because all they have to learn is what is going on in the bond market, and it'll tell them what to do in the stock market. When the bond market speaks, okay, let me tell you something. The stock market listens. It really does. And think, going back to the folks, think of we got all these layoffs. The FHA, I mean, I can never understand. They increased loans, the FHA, by 1,000%. Can you imagine that with all the problems we had back in 2008, 2009, the housing crash? 1,000% more. These people pay 1% down. And now these people are all in trouble. We haven't seen foreclosures this big. Now, you and I as taxpayers, we're going to have to bail them out, right? But that is going to also pressure interest rates up. So that's why this market, here's what we want to see at the end of the day. All I want to see the market do, and I'll put it up here, get this for you. Okay, all we want the market to do is this. If this can just do this for us, and it is right now, if we can get the market to, just trying to find the damn thing. Okay, here, I'll just pop it in for you. Oh, right here. Okay, so we get the S&P right now. Here's what we needed to do. I told my members, I want it to get up. I thought I put a target on at 565, where I thought we would rally, okay? 565, and then turn around and come back down. Now, again, I'm rooting that it goes right up where the high is and try to test the high, because if we can go to the high, and remember we went 7 months and they kept trying to break out, 7 months, couldn't break out. You knew the market was going to collapse. They've had all those tries after 7 months and no money's coming in, you're screwed. So we want to go as high as it can. In fact, we want to go right up and test the very highs, so that when it fails, it would be one hell of a crash, okay? But in the meantime, as you're investing, learn about how the bond yields work and how the bond market will help you with the stock market. Turn off the TV, turn off all that financial crap, and just listen to the bond market. It's your friend. Just think how wonderful it was that day from April 1 when he made that announcement that we're going to do tariffs, and the bond market did what it's supposed to do, right? It turned around and went up. Interest rates went down. It was protecting the 401ks and the buy and hold, right? And then all of a sudden the bond market's wonderful, and it starts thinking, oh my God, this thing's worse than I thought. So I got to do something here. So the bond market turns around, does the opposite. All of a sudden TLT goes down, all right, and interest rates go up, no longer protecting 401ks. That's why you got to remember, or the bonds, the 60-40. Never believe anyone who tells you that, okay, if you are diversified, you're 60-40, 60 stocks, 40 bonds, you're going to be fine. No, you're not. There's no place to hide. And the bond market does what's right. And think about that. The bond market in the beginning was doing what it's supposed to do. It was protecting the 401ks, protecting the 60-40. But as the bond market started to figure out, man, this yield thing could be bad for inflation, it turned right around. Instead of going up, boom, TLT went straight down, interest rates went up, and everybody went nuts, okay? But if you could use that bond market and understand that bond market, boy, you really become a good trader. You really do. And it makes sense. So Monday, remember, we had the market, right, drop because Trump disparaged Powell. Tuesday, the market rallies, right, due to the White House saying, well, we're working it out with China, the tariffs. They're not so suitable, but we're going to work it out. And the market went nuts. And then Wednesday, okay, morning, the market again soaring because, I'm friends with Powell. He and I are buddies again because that night somebody educated Trump on, hey, listen, man, if you start cutting rates, even talk about cutting rates, we're not going to get our European investors back here, and they're 48% of the market. No, don't fire him, for God's sakes. You want a huge crash? So there's little things in the market that can help you, but not CNN, not all those financial shows. So anyway, try my gang, philsgang.com, free for 10 days. See you on the charts.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.